So this week we're going to talk about money and banking. Did you know that 1 unit of currency that's introduced into the economy can be loaned an infinite number of times? And that ultimately leads to a reduction in the cost of money, or the reduction in the opportunity cost of money. And that opportunity cost of money is called interest rates. If you print enough money or introduce enough money into the economy, more of anything causes its price to go down. Yeah, that's right. So if you have more Mercedes-Benz, AMGs, if you have millions and millions of them, their price should go down. Unless, of course, demand goes up in Shanghai, and then maybe that's going to artificially keep the price of them up. That's right. The problem, or the good part about introducing money into the system, the more that's in the system, the cheaper its cost, interest rates. The cheaper its cost, what happens? Do people want to put the money into the bank and get interest? Or do they don't actually, because interest rates go down as more money is in the system. So what do people do when there's more money in the system? What do you do when you have more money in your pocket? Yeah, you're going to look for that was it BMW or Benz? Benz AMG. It's big Chev, the roof comes down. If you've got more money in your pocket, actually currency, if you've got more currency in your pocket, the more likely you are to spend it. I think of it like this. Right now, how much money do you have in your pocket? Does anyone have money in their pocket? Currency? Does anyone have currency in their pocket? I don't. In your bag? Okay, who has at least $20? Okay. $10? $5? Okay. So why? Oh, the card? Cards don't count. Cards not money. Actually, debit cards, credit cards, that's not considered money. That's a promise to pay. It's different. It's also on the test, by the way. I'll have to look up on that card though. If it's a card like that card, I think that might be money. I'll get back to you. But anyways, that card was the Presto card. Question.
So is it a gift card considered as money?
What kind of card?
Gift card?
A gift card is considered money. I'll have to look that up too. Okay, first of all, that's not on the quiz, but I want to look it up. I want to research that because I don't want to give you an answer that puts you in an accident. I'll have to find out about that. The question is, why do you carry money? All you need is a credit card or a debit card. Why do you carry money? First, some places don't use credit cards now. They don't take credit cards. Have you been there? Have you been to a shop that doesn't take a credit card now? Anyone? Uh-huh. Why? Why do you think? Ah, 3%. It's 3%. They have to pay 3% to the credit card companies off of that transaction, so they're losing 3%. What's also been happening during COVID?
I heard that like car schemers.
Card schemers, yes. And not just schemers, so fake cards, but then there's people not paying their bills, not paying. I go to get groceries, and once a week I have to put in my PIN. Usually it's a beep, because I don't spend more than $60, so usually you don't have to use your PIN when it's less than 60. But I've seen it more and more where they want you to put your PIN, personal information number in. I think that's what a PIN is. I think it's to check for not just like counterfeit cards, stolen cards. How about, I've had it where my monthly statement, the minimum payment is going up. Who has a credit card? Okay. Have you noticed at all? Are they asking for a greater percentage of a percent increase in your monthly payment? Have you seen that at all? No? I think I have. Once. But take a look at that. I just wonder, because if their defaults, if people are defaulting or not paying back their credit as fast, I think then the banks are putting up the minimum monthly payment to try and get it back. I've seen it once or twice. Take a look, just see if you notice it. So why have cash? First, some places aren't using credit. Debit, you have to be careful about debit because your information can be gathered by the shop where you go. Debit information can be found out. Credit information, But with debit information, there are some interesting things that can happen with debit information. People can find out things about you. With credit,
Why is that? Because I swear credit is more than
That's it. Why is that? Okay, let me clarify. One thing with credit, if there's a charge on it, it's not what you did, it's covered by insurance. You don't have to pay on a credit card. So if someone steals your credit card and they use it, and then you report it, you don't have to pay for the transactions. I've had that happen. But with a debit card, as soon as that charge is made on the debit card, it goes through. What's a what? An appraisal fee? With respect to what? An appraisal fee. I'll have to look that up. Find the ombudsman in the area. Ombudsman. 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 Find someone you can talk to about that. Because banks, first do your research. Is this a legitimate fee? And if it's not, that's different. But still, you should always know who you can talk to about banking fees. Okay. Where was I? Okay, so back to the original question, why do you keep cash?
Because you can use a debit card anytime. You can use a credit card anytime. Why do you have cash? Because some places don't take debit or credit. Me, I always have, always, at least $20 in my pocket. Not today, but I always have 20. Why? Because when you're walking along on the street and you see a yard sale, a private sale, cash is only taken. And, so that's one, sometimes, in other words, sometimes you can buy things that you cannot buy with a credit or debit card. So there's a convenience associated with it. But, and this is especially in Asia and in Latin America, in other words, not in Canada, but cash can get you a discount. Not at Walmart, but I've lived in Asia. There's a cash price, and then there's a normal credit card price. You get that in Canada too. I've gotten it. But cash can help you get a discounted price. So, credit, debit, it's good for convenience. You can use it anywhere in the world. But cash, it's always good to have some emergency cash on hand. Because then you're guaranteed service. Guaranteed service. The problem is that the value of cash goes up and down. And as we've already learned, the value of goods and services is always going up. So if the value of goods and services, if the price of goods and services is always going up, what's happening to the relative value of cash? Right, it goes down. So that's money in banking, really. That's it. We could go right now. We could leave. Except I know that you really want to do some math. One last thing before we go on. One bit of advice. Get yourself a credit card. Use it. Always pay the monthly required amount, the minimum amount, at least. I pay everything, but always use a credit card, always pay it. This comes from a convicted, one of the most well-known thieves, credit card thieves in the world. There's a movie about him with Leonardo DiCaprio. His name was Frank Abagnale. He was a really, really good thief. He would print checks and cash them and get the money, but the checks were worthless. That's one of the things he used to do. His advice is, and I think it's good advice, get a credit card, make sure you pay it off every month. Why? Because that gets you a credit rating. In the West, when you go for your mortgage or to get a loan at the bank, they check your credit rating. How many times have you borrowed money and did you pay it back quickly, on time? The more you do that, the higher your rating goes. The higher your rating, the more you can go into debt. Or the greater the amount of debt you can go into. So if you want to get a car, if you want to take a mortgage on a house, you can't do it without a very good credit rating. And having the credit card and paying it helps with that. End of story. Okay, money and banking. First, what's money? Money is the primary medium which is used to facilitate the trading of work effort for consumable goods and services or pay debt. That's money. Money is not an asset. Money is not an asset. An asset is something that you own, which gives you a return over time. Now you'll say, wait, if I have some cash and I put that in my bank account, I get interest on it. That's not the same. It's not the same. Because as soon as you put your currency into the bank account, that becomes a loan to the bank. You're loaning it to the bank, then they're giving you interest on that money that you've allowed them to use. So, what's money? It's a medium. What is it? You work. You work. You get up in the morning, go to work, so you can get paid, so that you can buy the stuff that you made. Thank you. How do they pay you? They pay you in coconuts? No, they pay you in the local currency. So what's that currency? That currency becomes that currency is what your work effort is translated into. What's currency? Currency is what you get for being productive. Increased productivity, increased currency per hour, wage rate. So currency is where your work effort is stored. Then you can put it in your pocket, and then you can go buy that Benz AMG. You can't just go to the Mercedes-Benz AMG shop and work for them for the car. So, what's currency? What's money? What's money? It's just convenience. It's a means to increase convenience, to trade work effort for goods and services. Now, when you put your money in the bank doesn't have to keep it all for you. What they usually have to do is they keep a certain amount of it for bank robbers. And in case there's an emergency, like the zombies are coming, in case there's a bank run, in case people get very, very nervous and they want to take money out. There has to be so much money in the bank. That's why they're called demand deposits. A deposit account is really a demand deposit account. On demand, if you demand some money from your bank account, they have to give it to you. Therefore, they have to have so much money, a certain percent of all of the deposits have to be kept in the bank or at the Bank of Canada, the central bank. So here, we're going to calculate the percentage that has to be kept in the bank. There has to be There has to be some there in case people want cash in their hands. So calculate the reserve ratio to decimals. If deposits are 20 and reserves are 10. Well, if deposit, that's a CQ for checking. RD is the desired reserve ratio. Reserves, the amount of funds that financial intermediaries must keep as cash. Then the desired reserve ratio, let me put that in purple for you. The reserve ratio is equal to reserves divided by deposits. So how much is kept in reserves in cash divided by the amount of deposits gives you the reserve ratio. Here, reserves are 10, deposits are 20. That gives us a desired reserve ratio of 0.5. Therefore, the reserve ratio is 50%, or 0.50. If you look at StatsCan, over the past 3 years, it used to be, in the past, that the desired reserve ratio was 10%. But then the financial crisis, 2008, and then COVID, and right now, the desired reserve ratio, there isn't one in Canada. Yeah. United States, no. There's no formal desired reserve ratio. And keep this in mind. Who's in charge of the financial system? Who monitors? Who legislates? Who determines what you can and cannot do in the financial system? What's the color? Green. Who monitors and tells the banks and trust companies what they can and cannot do? Green. Who's green? Government. But the government lately has said, do what you want. Just be smart. In 2007, 2008, the reason why Canada did not suffer as much as the United States, for example, was because our financial system was very strong. The past 3 years, the Canadian government has said, we're having very difficult times. Do what you think is best. What do you think has happened? It's a very interesting time, my friends. The system in Canada has gotten worse. The financial system has become less stable. It can be argued. Okay. And stability is one of the most important factors in the financial system. You want to have stability because as soon as, well, what's the opposite of stability? Instability or and what does instability cause? Uncertainty. And what does uncertainty cause? Risk. Do you want your country to have more or less risk when all the other countries in the world have increased risk? You want less risk. So, that's what's happening now. Next, What's the deposit multiplier if checking deposits are 20 and reserves are 10? The deposit multiplier is how many times does a dollar that is entered into circulation, how many times does it multiply? Or how much bigger does the money supply get when $1 is introduced into the system? Because recall from the beginning, if the government introduces $1 into the system, it gets loaned many times, an infinite number of times. So $1 that's introduced into the system causes the system to grow many times. This is just like the marginal propensity to consume and aggregate expenditure. If the government spends more money, then real GDP increases by the multiplier. This is the same exact idea. Thus, we look at the math. So, if, let's see, the simple deposit multiplier, what did I use for my, oh, it's just M. Okay, so then the desired reserves, we need to do two calculations here. First, we need to find the reserve ratio. The reserve ratio is going to be $20 over 10, or 20 over 10, 0.50. Therefore, the desired reserve ratio is 0.5. The multiplier is 1 divided by the reserve ratio. 1 divided by the reserve ratio. So the reserve ratio is 0.50. That gives us a simple deposit multiplier of 2.0. So, for every dollar placed in a checking account, that amount becomes twice that amount becomes available for money supply creation. And what is money supply? Those are loans and deposits. So far, so good. Do you recognize the math? Do you recognize the math from last week? What's similar on the multiplier? This week, the multiplier is 1 over R, but the autonomous expenditure multiplier last week, 1 over 1 minus MPC. Same kind of idea. Same kind of idea. $1 earned in your pocket is spent many times. Here, a new dollar introduced into the economy is loaned many times, and that expands the money supply. So one, earnings expand expenditure many times. Here, new money expands the money supply many times. And next week, if we're here, government expenditure expands the overall new government expenditure expands aggregate expenditure many times. Same math, same idea. And next week, it'll still be the same, 1 over 1 minus MPC. Same multiplier. This is a different multiplier, 1 over the desired reserve ratio. So the next question is, what's the maximum increase in checking account deposits given a reserve ratio of 5%, open market buying of 10 of government securities by the Bank of Canada? So the question here is, last week it was, how much does aggregate expenditure go up given some increase in expenditure in the economy? Here, how much does the money supply increase if someone introduces $10 into the financial system? Same idea. New money into the system, new expenditure into the system, increased economic expenditure. Here, increased money supply. And we'll get to why money supply is important a little bit later. So, desired reserve ratio. Well, the change in checking deposits is going to be 1 over the desired reserve ratio times the change in reserves. So that's 0 over 0.5 times 10, which is equal to 20 times 10 is equal to 200. So an increase in $10 of reserves caused by the buying of $10 of government securities from financial intermediaries by the Bank of Canada through open market operation purchases leads to a maximum increase in checking account deposits, and that's M1 money supply, of 200. This is happening all the time. But right now, it's in reverse. The Bank of Canada is not buying securities from the banks. Securities are short-term treasury bills, 30-day T-bills, T-bonds. 30 days, you put your money, you loan the bank, you loan the government money for 30 days, and then they pay a little itty-bitty bit of interest, and then you, over that 30 days, and then you get your money back. Right now, oh boy, I think on 10s, 10-year is 3% in the United States. I didn't check my numbers today, but over the weekend, last Friday, the Bank of Canada, the Government of Canada's agent, increased interest rates. Do you know how much? What? Ooh, I'm impressed. 1%. Got some on the ball students here. That's not buying of securities. When the Bank of Canada buys, that means they're putting money into this. You're taking your debt out and putting currency in. So to put interest rates down, because more money in the system, the price of money goes down, that's interest rates. Here, interest rates went up 1%. So what the bank was doing was taking money out of the system by forcing the financial intermediaries, banks, trust companies, insurance companies, to buy back government debt. That's what they did on Friday. Last week, the week before, the week before, the week before, for the past 3 months, that's what all major countries in the world have been doing, is that their central banks have been taking money out of the system and replacing it with government debt. That's what's been happening for the past 3 months, minimum. Because as you may or may not know, interest rates have been going up. Well, they have to, because interest rates have been at 0 for the past at least 3 years, probably closer to 5. Not for us. But interest rates for huge major corporations. Oh, it's actually the interest rate on deposits that banks have with the central bank. If a bank has excess deposits, excess reserves, they keep it with the central bank, and the central bank pays a little bit of interest overnight on it. That's the rate that you're hearing about that went up 1%, the overnight rate. That's not what we're getting. But that roughly translates to, we have to pay at least another % on our debt. Roughly. When it goes up 1%, that's for the best clients. We're not the best clients. That means your mortgage that you're looking for, it didn't go up, the cost of it didn't go up 1% on Friday. It probably went up 1.75%. Because you're not as good a customer as the banks. Questions about that? Any questions at all about that?
What do you mean when you say that the central bank is buying it's putting money out of the system and putting in the government debt?
Yep.
What does that mean?
What does it mean when they're taking money out of the system and replacing it with government debt? That's complicated. The government is continuously creating debt because it has to finance its operations. It doesn't have enough money through taxation. Taxation is the government's revenue. If it doesn't have enough for its spending, because say it's got programs to help people survive a pandemic, it has to go into debt. So it's always renewing its debt, whether it's 30-day debt, 3-month, 90-day debt, 1-year debt, 3-year debt, 5-year debt, 10-year debt, 20-year debt, and longer. There's a whole bunch of different lengths of time of debt issue. So this debt, banks have some because they hold it as assets. Other countries have it. Private citizens take this debt as an investment vehicle. So what the government does is, it says, oh, we need to reduce the amount of money in circulation. You have some of our debt. What we're going to do is, we've got some debt too, because we've been buying it lately. That's QE, by the way. They didn't buy it. And I won't go into that because it gets really complicated. They're exchanging years, how long the debt is that going through. So what they're saying is, we're going into debt. We've got a new debt issue this week. Because they've got new debt coming out every other week, let's say. We've got some debt coming out, you're going to buy it. The banks can't say no. Because, remember, we've got the three little houses by the financial system? What's the color that surrounds the three little houses? Green. What are you going to do? It's not the government though. That's government, but the Bank of Canada is the government's agent, arm's length agent. They don't have to do what the government says, but they act together as a team to do what's best for the country. So it's not the government is saying, you have to buy our debt. It's Bank of Canada saying, it's a really good idea that you do this, because this is the plan for the future. Agreed? Agreed? Agreed. And let's face it, the Bank of Canada is continuously talking to all of the financial intermediaries and all of the businesses in the country and all of the other major financial systems. Therefore, they have information about what's going on in the world, major trading partners. So in theory, it's a good idea to do what the Bank of Canada says. That's a really complicated question. Good question.
Next, what's the maximum increase in the money supply? Well, this is essentially the same question, because money supply is equal to whatever currency is in circulation plus the amount of deposits plus the amount of loans. So it's essentially the same question. It's just now I'm using the term money supply. Given a reserve ratio of 10%, a deposit of 10 into the checking deposits, and an increase in 10 in bank reserves. But now the question's a little bit different, because we've got reserves. And we have to calculate because we have reserves. So much money, you put money into deposits, that gets multiplied, but a certain proportion of that money has to go into reserves, so it's not in the money supply. So you have to subtract what goes into reserves from the multiplied amount to get the maximum increase in money supply. Okay, no big deal. Shouldn't be a problem. So it's checking deposits times 1 over the desired reserve ratio minus the change in reserves is going to give us the change in the money supply. Well, change in deposits 10. Someone deposited $10 into their checking account. And that's going to be multiplied 1 over 0.1 times. And then we have to subtract the change in reserves, which is 10. And so that's 10 times 10 minus 10. That's 100 minus 10. That's 90. Therefore, an increase of 10 in checking deposits in conjunction with an increase in reserves of 10 leads to an increase in money supply of 90, given a reserve ratio of 10%. A different way to think about this at a personal level.
Someone gives you $100 for your birthday. Do you spend it all? No. You take 10, put it in the bank, and then you keep 90 in your pocket. That 10 that goes into the bank ends up growing the money supply. You're holding the 90 in reserve. So it never has a chance to multiply. Just a little bit different way of looking at it. The key here is the financial intermediaries have to keep some money as insurance if people come and they need some money to go buy something using cash.
A true and false question. Given the data and a reserve ratio of 10%, loans should be 45,000. True or false? Anyone have a idea? 10% reserve ratio. Loans should be 45. If the reserve ratio is 10%, what should the reserves be? Is 10,000 accurate? Is 10,000 reserves, is that the right amount, too high or too low, given deposits of 50? Too high, what should it be? 5,000. So what should loans be if assets equal liabilities? $45. Who understood that? No math, just I understand the picture given 10% reserve ratio. Good. That's how you fight the question. You work backwards from deposits, in other words, in this question. You work backwards from deposits. Assume deposits are correct, or assume that liabilities are correct, and then you have to alter the assets. Just remember, assets equals liabilities. Left side equals right side. So, the math. Well, reserves are going to be checking deposits times the reserve ratio, desired reserve ratio. What are our deposits? 50,000. Oops, excuse me. So this implies, 5,000. So reserves is 5,000 times 50,000 times 0.10. That's what the reserves should be. That's what the reserves should be given the desired reserve ratio. What are they? Well, deposits are 50,000. Reserves are 5,000. This is what it should be. Plus loans. So that means loans are equal to 50,000 minus 5,000. Which equals 45,000, therefore the statement is true. And again, right now, as far as I know, right now in Canada, there is no desired reserve ratio. So it's up to the banks and the trust companies, mutual fund, all of them. It's up to them to keep a safe amount of cash on hand. And that scares me. Questions?
What is the statement?
Loans should be 45,000 given the data. Given this data, this statement is true. So right? So right. All good? All good. And now for some interesting theory. The quantity theory of money. This is by a gentleman known as Irving Fisher. A really smart and creative person. What Fisher said was, well, let's take a look at this. Here's the question. If the money supply, that's all of the money in circulation plus the money in deposits plus loans, times the number of times the money supply gets spent a year. So all the money in the system times the number of times it gets spent. So all the money in the system times the number of times it gets spent. Now this goes back to aggregate expenditure. It goes back to aggregate expenditure. Because remember, $1 earned is earned and spent many times. $1 earned is earned and spent many times. Because you earn, you spend it, that means whoever made what you bought gets paid, then they take that, then they can buy something, someone else that made something gets paid. $1 earned is earned and spent many times. Same kind of idea. The number of times that all of the money gets spent in a year, what does it equal? What does M times V equal? What is the value of the money supply spent in a year? Keep it simple. Look at the math. Think of aggregate expenditure, the aggregate expenditure model. The total value of money spent in a year equals what? Excellent. Real GDP. Oh, is that real GDP? It's not? What is it? Nominal. Close. Because the price level times the real output will give you nominal. Yeah, that's right. Good. So, in other words, and so there you can start to see if whatever the Bank of Canada does with its buying and selling of securities is going to radically, in theory at least, it's going to affect the ability of the economy to maintain its productive capacity. So the amount, if end of story, whatever the Bank of Canada does to increase or decrease the amount of money supply in the system is going to directly affect output. But that's the easy way to do it, to look at it. We're looking at one number. Now you turn it into growth, percent change. So it's not how much did the Bank of Canada buy last week? That's not the question. The question is how much they're always buying or they're always selling, but rates went up. So that would suggest that they're buying, no, they're selling this week, last week, they're selling to the financial intermediaries to get those rates to go up. They've got to grow the amount that they're selling. So it's not just, I'm going to sell X, it's going to be, I'm going to sell X times 1+ percentage, maybe 5% more they're going to sell this week as opposed to last week to get a growth in the reduction in money supply last week. So that's the way it is. It's a growth model. It's never as simple as 1 + 1 = 2. It's 1% plus 1% = 2%. And it's always changing. So here, and that's why monetary policy, the 1% increase last week, it's so dangerous. And that's why in the United States, they were in December last year, the question was, is inflation transitory? Remember that? If you don't, that's cool. But in December, everyone that thought they knew what they were talking about, plus a lot of people that don't, were all talking in the States. Is inflation transitory? Is inflation transitory? Is inflation transitory? You know why they're doing that? Because this is not easy. Increasing money supply, decreasing money supply to alter interest rates. Given what's happened lately in the past 2 to 10 years, financial crises, manipulating money supply is a dangerous thing. Because look, we know which. Is it going to do this? Is it going to do this? Is it going to decrease, increase, grow too fast, grow at just the right speed? So they were talking about transitory inflation in December. Why? Because they wanted to get us prepared for what was going to happen, so we all didn't go crazy when it did happen and cause huge gyrations in the markets. So, how fast does money supply have to grow given these parameters? I introduced this idea last week, the dot. That's another way to say growth. when you put a dot over a variable. That's growth. Instead of putting percent change money supply, M dot. That's a standard way, that's standard in math. I would imagine you'll find this in engineering, it's everywhere. The dot is growth. So we have all of our growth. The cool thing so we start with MV equals PY. But there's no dots here. This is all just a number. As soon as you put a dot on these, on growth, then it becomes M dot plus V dot equals P dot plus Y dot. Remember that for the rest of your university lives. If you have variables that are multiplied by each other, they become additive when they are taken to growth. Incidentally, if I had M by V and I translated that to percent change M over percent change V, what would be the math then? If multiplication is addition, what is division? Yep, what's that? If multiplication is addition on growth, what will division be? What's the opposite of addition? Subtraction. Yeah. Just a little trick for you later on that'll come in really handy. You don't need to know the well, you do need to know the minus because it's in here as well. So money supply growth is going to equal inflation plus growth in output minus velocity, which is the same as saying that M is equal to PY over V, but you're just going to percent change. So that's 1% plus 1% minus 1.10%. That gives 0.9%. Therefore, the growth rate of money needed to maintain the desired growth of the economy given expected inflation and money supply growth is 0.9%. And this is what's happening right now. Are they growing the money supply now? No, because the price of money is going up. They're shrinking money supply. At what rate? Well, it depends. How fast are they shrinking it? It depends. What's inflation? Because P is inflation. What is inflation now? No one knows. No one knows. They think it's around 7%, but that doesn't take student survival into account. Textbooks, pizza, and coffee. 7% increase in the past year? I don't think so. So they don't really know what this is. They have an idea. And this, real output, they have an okay idea. The only problem with real output is the data is 3 months old.
when you get, real GDP increased 3% in the last quarter. They got that data from 3 months ago. So what's happening now? That's why I like to go talk to the cashiers at the grocery stores and people who use their hands to make stuff, because they are always needed. You find out economic activity by doing research, by researching and asking the people that are necessary. That's my model. You have your own model. But you see where I'm going with this. What they did on Friday, we'll see what happened. But that's why you'll see the stock market, equity markets, Forex, foreign exchange. The US dollar was appreciating versus the euro until last week. That's why if you're smart, you've got a trip planned to France in 2 weeks after all of this is over. Because the euro is really cheap, the Canadian dollar versus the US dollar has stayed relatively stable. So your trip to Europe, the money that you need to have fun, it got cheaper. It's been getting cheaper for the past 3 months. So this course, I introduced it as Advanced International Shopping. Now you know why. It's really Advanced International Shopping, Advanced International Travel, so I can go and do Advanced International Shopping. So in summary, you trade your money for effort. Money is really ultimately just good for purchasing stuff later. It's for convenience. Money supply growth is used to moderate price instability, inflation. And it's also used to minimize unemployment. We'll get to that in 15 minutes. So please come back. Let's see, it's 225. 225. 225? 225. And I have some time if you need to discuss with me